Welcome back, guys, to another roundtable. My name is Adam. I have Rusmin.
Hello.
And Victor.
Hi, everyone.
Thank you so much for joining us today. And we're going to talk about China once more. So we did a roundtable on China recently about, Year of the Dragon. Is it going to turn around? And I mean, China, we all know China is cheap. Regardless of what you think about it, the market is cheap. And some viewers were asking some questions. How do you actually, we mentioned some companies in China that had some potential. So then someone was asking, how do you actually value those companies? How do you do it? Can you show it to us? And we decided to do it for today. All right. How do you actually value some promising Chinese or Hong Kong stocks? And one of them was actually one stock which was paid to wait. Basically, you earn a dividend and you get paid to wait. You want to cover how you value these things and why we think there are some these kind of opportunities in the Chinese market at this point in time. Okay, so one of the companies that we want to bring up is basically Alibaba. Because Alibaba is a big name and it is cheap. Okay, so we're going to bring up how we're going to value Alibaba and we're going to compare it to its fundamentals. And, is that cheapness actually worth, looking at?
So the question on how do you value Alibaba, I think first you need to understand Alibaba core businesses, right? So they have main 6 businesses. The first one is their China commerce business. This includes their Taobao, Tmall, and a few others like your Fresh Hippo, Alibaba on 1688, so that's the main China e-commerce business, right? And then second business that they have is the international commerce business. They have business like Lazada, which I shop a lot, AliExpress, and of course that's their second business, and a few others, right? And the third business is their local consumer business, ENROLMENT, right? And a few others as well. I just want to keep it simple. And then the fourth one is their logistic business, which is their China, and the fifth one is the cloud business, and then followed by digital media entertainment business like Youku, right? So these are the main 6 businesses that we need to look at them. And if you look at their revenue by segment, I think you can see that China e-commerce business is the largest one, right? I think as of 2023, I think they account about 582 million as of the year ended 31st March 2023. Okay, so that's their full year result. Okay, so this actually account at least 60 to 70% of their revenue. Okay, and the rest, of course, you have the international e-commerce business, local consumer business, and then cloud business, right? And so I think if I were to look at Alibaba, actually, if you look at their all the businesses, right? I think China commerce business is the largest. Okay, why? Because if you look at the adjusted earning before interest, tax, and amortization, that business alone actually accounted about 185 billions renminbi. Right, and the rest of it are either loss making or some barely just break even. Like a cloud business started to make profit in I think 2023 about 1.4 billion. But if you compare the 1.4 billion versus their China commerce business, it's about 185 billion. That is peanuts, right? Okay. So that's why I think China commerce business is the main thing that we should be looking at. Okay. So of course, how do you value them, right? So there are a few ways that you can look at it. You can look at it on a group level because you can't ignore the other businesses that are still loss making, and that is those businesses have a dilutive effect because they are investing it for the future, right? Like their logistic business, they're plowing a lot of money. Same thing for the cloud, and a few others like local consumer businesses. So that you need to take them into account. So on the group level, you are looking at about 148 billion. So you can look at their historical valuation on enterprise value over EBITDA. Okay, so I think generally Alibaba trades at range between 40 in the past, before the regulatory crackdown, to now after the regulatory crackdown as low as 5 times. Okay,
that's really very
so
low.
It's a big spread over there. Okay, but on a normalized level, if you based on the 5 years figure, on average they're trading at about 20 times enterprise value over EBITDA multiples. Okay, right? So that's one way you can look at it. But if you stretch out to 10 years, I think you're looking at 30 years average. So now you have established of a average valuation on how the market actually value them over the history of 5 years to 10 years. Okay, and based on that, of course, you have your EBITDA without the depreciation, which is what the Alibaba group actually always presented to you. And you, based on a per share basis, I work out to be around $8.67. Okay, based on the annualized or rolling 12 months figure. Okay, and this is after the conversion from their renminbi, which is what they reported in. So I need to convert to Hong Kong dollar because the shares are listed in Hong Kong Stock Exchange and of course in the US as well, right? So, but I'm just referring to Hong Kong side. So if you base on the 20 times multiple, which is basically their 5-year average, which take into account of derating, right? That will gives you the intrinsic value of $173 versus the price at this time of recording is about $75. Right. So there is a huge margin of safety at about, I think, 56%. Yeah, so this is kind of like showing you that, looks, Alibaba is cheap, is significantly undervalued, right? And the reason why it is cheap is primarily because they are actually, they were facing a lot of competition on their China e-commerce market, right? So in the past, they used to command 60-70% market share. In fact, it used to be like 80%. And then, of course, you have Pinduoduo, JD came into the market. That market become more crowded. So Alibaba started to lose more share. And their share actually hovering at between, I think, 60%, even with JD and Pinduoduo, right? And then, of course, since the pandemic started, you have Douyin, which are very popular in China. It's almost like our TikTok, right? Short form video, where they also enter the e-commerce market, right? They do live streaming, and then they let their influencers started to sell product, right? Auction. It's almost like
pretty
those
entertaining, actually.
Yeah, pretty entertaining. Yeah. So those actually take away some of the market share from Alibaba, and of course you have Kuaishou as well. Okay, so and over time, I think Alibaba market share now has dropped to 40%, and which is what a lot of people are now very worried, because their e-commerce market now is getting more competition, and then the margin also used to be like, I think, 50%, and then now has dropped to about 30% operating margin, right? So, and that is the main concern right now. And now, of course, the other thing is that the cloud computing is also one of the key growth driver in the past, but the growth has stalled. Okay, and of course, since last year, there's a change of new management. The co-founders have come back, Eddie Wu and of course Joe Tsai. Both of them have come back to manage Alibaba. They're trying to revive the growth of the company, and if they are successful with that, then potentially you may see Alibaba re-rated upwards. Okay, so there will be our bull case scenario where you can apply your 30 times multiples, right, instead of like 20 times. But at this stage, I will use 20 times as my base bear case. Okay. Yeah. So that's one way to do it. Okay. Of course, you can use other method like non-GAAP diluted earning per share. All right. And yeah, so generally for a business that is very have a huge market share, they can trade easily at 15 times PE. If the growth come back, of course they can go up to above 20 times to 25 times. All right.
So what you're saying is that historically over the last 5 years, EBITDA was about 20 times?
20 times on average based on 5 years.
But now it's
data. Yeah.
Now it's 5 times.
Now it's like 5-6 times.
All right. So it's very cheap. But then, like you said, there are a lot of challenges. So I think someone who's watching this could have the question, hey, yes, it's cheap, but it doesn't look rosy. Yeah. So is it then, which some people say, is that a value trap then? Or is there a potential for, I mean, you said that these two guys are coming back, hopefully to revive its fortunes and all that, or its growth. What would you say if someone says, Alibaba's a value trap?
Yeah, so there is a risk for that because competition in China is real, and the price war is always there, and they do have a lot of subsidies, incentives in the market, especially if they are trying to introduce growth. They will throw in a lot of vouchers, coupons, and all that stuff, and that will sort of erodes the margin, right? So that's why Alibaba now still lacks catalyst, right? So it could be a potential value trap. But what the management is doing is, of course, when you have the co-founder coming back to run the business, that is usually a good sign, right? Because they know the business inside out. It's almost like Starbucks. You have Howard Schultz, came back and run the business, and then it's not the first time or second time, right? It's the third time that he was doing it. And we have seen many times in the past where when the co-founder came back to run the business, usually it might work. But now the competition landscapes are very different. Okay. So I'm not sure whether the co-founder can turn around the business, can revive the growth of these businesses that are trying to
I think usually last time when people talk about value trap, is usually the industry itself is dying. Right? But in this case, Alibaba's e-commerce is growing. I think recently there's a video interview the Zhou Zhi, that he says that the China e-commerce penetration rate for total retail is about 30%, right? It's even higher than the US. And if you think about it, he was saying like the next few years it will go up to 40%. So it's a growing market for the e-commerce. This is the first thing. Second is the cloud itself is still a very early stage, and it's a growing market in China. And Alibaba is one of the top player, or maybe the biggest player for cloud in China. So I think in terms of value trap, we also have to really see. I mean, yes, there's competition, but the whole industry is growing by itself.
Okay.
Yeah. And of course, he is not just saying that, he also using his money to show that, he's confident. And he actually bought back share 152 million.
Wow.
Right?
Okay. That's quite a
from
bit,
the off market in the fourth quarter of 2023 last year. Right. And of course, the other one who bought back share is Jack Ma. Okay. He should come back. That make the whole Alibaba story more exciting.
Yeah. So I think someone who's watching this, like, okay, so they understand that basically the landscape is a lot more competitive.
Yeah.
But it's a growing pie, and if you get into something like this, you just need to know that it's actually almost like a bet on these guys being able to basically revive the growth.
Yeah.
I mean, Alibaba's there here to stay. It's a big company. It's not going to go anywhere. But whether they can continue growing back, like, no, I mean, I wouldn't say growing like how they used to be like 10 years ago. Because there's just tremendous amount of growth. But whether they can just bring back some level of growth.
Yeah.
And that could basically revive the stock price, basically.
Yeah. Without it, I think Alibaba would just be a cash cow. It's just trying to maintain their market share, and that valuation may stay cheap.
Okay. So those are the risks that you need to be aware of whenever a stock is cheap. These are things you need to watch out for. Yeah. Could remain cheap for some time, but it is cheap. Really based on historical values. So that is Alibaba. And there's another stock that we wanted to bring up because Victor mentioned it in the last roundtable on China, that there are some companies that are China, Hong Kong, but they're not actually in China or Hong Kong.
Yeah.
And this particular stock is actually a dividend play. So even if you buy something like that, you get paid to wait. Yeah. You collect dividend in the meantime, and the yield is actually pretty attractive. Income investors or people who are both like income investors and they want to do a turnaround at the same time, could be really interested in this. So this company is CKI.
Yeah,
or
Cheung Infrastructure. So basically, the infrastructure asset is rather resilient, right? So if you look into their assets, right, majority of the assets are in electricity and gas assets. Right. So basically, when you want to transport your electricity from the power plant all the way to or gas all the way to the residential house, they are the one that owns the pipes. Right. So all this, right, the cost can be passed down if there's an increase in energy price and all this, right? Because it's a must pay. And a lot of their assets that they own especially in UK and Australia, is the only source over there. So it's like a monopoly assets over there. So, and if you look into their profit before tax, right, China and Hong Kong is just 2% of their
just
total,
2%.
Yeah. But in revenue is 30%. Okay. But in the profits it's just 2%. Right. So the contribution is much less. Mostly is from UK and also from Australia. That's their main assets. Right. So like I told you, the moat is that they actually a monopoly assets, and all these are essential. Yeah. Right. People have to use day in, day out.
You have to keep the lights on.
Yeah, your electricity, your gas, and they are able to pass down the costs. Then if you were to look at their valuation, because it's an asset type of company, right? If you use price to book, right? 10 years price to book, their average is around 1.34 for the past 10 years. And right now they are traded below the average, around close to less than 1 time. Okay. Previously, a few months ago, they are traded about 0.75 time price to book. Right. Okay. And all these are strong infrastructure assets that continuously increasing their dividends. Right. So if you look at CKI, they have been increasing their dividends for the past 26 years. Okay. Yeah, you didn't hear me wrongly. 26 years.
Every single year.
Every single year.
So that's a dividend aristocrat.
Yeah.
Yeah, in a sense.
So even right now, their share price has tanked, right? Because majority of the assets is in UK and also in Australia, especially because because of the Brexit, right? Because of this news, right? Since the Brexit happens, right, their share price has tanked significantly. Okay. Right. But then before this actually happens, right, their yield of this company, right, is always traded at very low. You only can get them for like less than 3% yield. Okay. Right, because it's so consistent. their assets are every 5 years they got this thing called regulatory reset. They recently a few of their major assets already resetted already. So that means from 2023 all the way to the next 5 years, your dividend is secured.
Okay.
Yeah. So it's confirmed there already, right? And because they reset all the major assets, right? So moving forward, you can see that they will still continue to maintain the increased dividends. And right now, if you look at the yield, right, it's about 5.4%. Okay. The last time, the highest yield that they ever get, right, was during the 0809, and that was 4%.
Wow. So it's even higher than that.
Yeah, right now, a few months ago was 6+%.
Yeah, okay.
But recently the share price has came back up. So now it's still 5.4%. It's still way higher than their 0809 types of valuation. Right?
All right. So that's how you would value CKI based on its yield.
Based on its yield, based on its price to book, because it's an asset business, you know.
So based on yield, because like say an income investor looking at this, they're looking at CKI 5.4% is actually pretty decent.
Yep.
And it's a very stable company.
Yeah. 5.4%, you're looking for very good track record increasing dividend. I think there's high probability that they will continue to increase dividend moving forward.
I mean, it's a 26-year track record of,
and their payout ratio is still less than 100%.
Okay.
So there's still room for them to increase the dividends. Right?
Okay. So any risks when you look at CKI?
Yes, definitely there's a risk. First is, like I told you, there's a regulatory reset. Sometimes, right, they will reset at a lower price.
Okay.
Okay. So that happens to one of their asset. Okay. But most of the asset, they manage to increment the thing. Okay. They can pass down the cost to the consumer. Okay. And also because majority of the assets is in UK, so that the Brexit, right? Because of the Brexit, that's why the share price has tanked.
So would you say the price came down because of Brexit, not actually because of China, Hong Kong?
No,
or is it related as well?
It firstly came down because of the Brexit first.
Yeah. Okay.
Then the Hong Kong protests came, so it continued to drop. Then the recent
foreign investor
push, their share prices just go down. They are affected, but actually their business is not.
The business has not changed.
Not changed.
So the stock price is like that, but the business, I mean, it's infrastructure.
Yeah.
Infrastructure, you can't really move a lot every day. It's the same thing.
People still have to use the gas and all this, and they are able to. They have this pass-through thing lah. They have pass-through cost.
And dividend increased.
And dividend still increases every year.
Yeah.
Wow. Okay. So
still increase. Even though their share price have been tanked since I think around 2016, that was the peak.
Okay.
Until now, but their dividend just continuously increased from there.
Okay. So someone who is, I mean, this is, then someone could ask you, say, hey, look, I invested in this maybe some years ago.
Yep.
And then, but share prices come down. Basically, I'm sitting on a paper loss.
Yeah.
But then you have a dividend coming in. Would you sell? You wouldn't, right? Because you're still getting a dividend that's increasing and all that stuff.
Yeah, I think because this company have track record increasing dividends, eventually, right, if the share price continue to tank, the dividend will keep increasing, right? Then the yield
will keep increasing.
And I'm not saying that they own bad assets. They are owning good assets that they are monopoly in that country and that's passed through.
Okay.
Right. So I think, and also how they grow is throughout the years they have been acquiring new assets. So recently, right, they have been paring down their debts. So when any new assets surface, right, they are able to take on more debts, right, to buy new assets to increase the dividend moving forward.
Okay. Yep. All right. So moving forward, you said the last roundtable, this is something that you basically paid to wait.
Yes, correct.
So you're waiting for, I guess, a catalyst that could.
Yes. I think you paid to wait for the re-rating of the assets, right?
Okay.
Because now people are still very pessimistic of the Brexit and all this.
Okay.
And also China. So that's why the price is so depressed, right? But you are being paid like 5.4% to wait.
So actually, you're basically kind of banking on the sentiment to shift.
Yes,
because the fundamentals actually for example, like something like CKI, the fundamentals are not going to shift drastically because it's such
because it's fixed for the next 5 years.
It's a fixed company. It's not
they
so
just reset
dynamic.
every 5 years only. Their revenues and net profits are fixed for the next 5 years.
So in that sense, that company is actually very predictable.
Yes.
And the only way that this could actually turn around is a change in sentiment.
Yeah.
It's a play on that.
Their business is so predictable. Their credit rating is A credit rating.
Wow.
So that's why a lot of the lenders like to lend them money because they are a very predictable business.
Okay.
And because they are in so many countries, their currencies are all hedged. So it's fixed already.
Okay.
There's minimum moving parts on that.
All right. So this is a play of specifically just, I guess, being paid
to wait.
Paid to wait.
Yeah.
And as a dividend company, it kind of like checks all the boxes as well in terms of payout ratios
correct.
and dividend track record and stuff like that.
Debt and everything. Yep.
All right. So I think if you're interested as an income investor about how to like basically pick companies like that, CKI is one of them. Do check out Dividend Machines. It's actually open right now. As of this recording, I mean, by the time you watch this, I don't know when it's going to be, but from now till 18th of March, 2024. Dividend Machines is open for enrollment right now. So if you're interested to learn how to build a portfolio of dividend stocks and REITs that pay you stable plus passive income year after year, and how to pick dividend growth companies basically, do check it out if you're interested to learn how to do that. So do check out dividendmachines.com. We'll put a link in the description as well. So basically CKI, great example of that.
Yep. In fact, it's one of the case study that we put on the Dividend Machines. When they come to attend the live webinar, they're going to get to see Victor doing a deep dive on CKI. Because
I just do a brief.
This is a brief example of what it is.
Yes.
But during the web class, the webinar,
you go deeper.
You go into the methodology and everything, how you analyze and stuff.
And why Victor thinks that this is a solid dividend stocks.
And usually I will talk about the Singapore banks also.
Okay. All right. So again, no recommendation to buy or sell anything during this roundtable. We mentioned a few companies here, but we just want to bring them up to you as examples of how you can actually look at distressed assets. I mean, it's not exactly distressed.
Not exactly distressed.
It's just pulled down by the entire market, the sentiment. But you strip away the noise, the layers, the rock there is still very consistent dividends. It's growing every single year. Yeah, so I think it's something that if you're an income investor, it's something you could check it out for yourself. Again, please do your due diligence. Is there anything else that you can share about CKI? Is there anything else that you want to share about
I think that's all for it.
Okay.
Yep.
All right. So
more at the live webinar.
So if you're interested in Dividend Machines, do check it out. It's basically an online video course which you can access anytime. All the videos, over 50 videos, are there for you to learn. But we have a live web class component as well, where you attend live, and then Victor and Rusmin are there to basically run through the whole investment framework with you, sit down with you online, and run you through the process.
On how to build your dividend portfolio.
Yeah, so if you're interested in learning how to build a dividend portfolio for dividend investing, do check out dividendmachines.com until the 18th of March 2024. All right, after that, we're going to close it. That's it. All right, so is there anything else you want to share about, either Alibaba or like CKI? Because CKI is a Hong Kong stock basically. But its assets are elsewhere.
Outside.
But again, dragged down by the whole China-Hong Kong thing.
Yes.
So, but I think we show these two companies mainly also because to share with you, Alibaba is a typical value growth stock, right? Where it started paying dividend, but the dividends are peanuts. So it's not a dividend stock, I would say. And when you buy this type of stocks, you don't get paid to wait, right? Because you have to wait for the share price to go up, for the re-rating to come, for them to revive the growth. Then you will start to see capital gain, right? And CKI on the other hand, you might get both, right? But it's just that at this stage, even if the re-rating doesn't happen, you get to enjoy that 5.5% yield and growing dividends year after year.
But the upside won't be as much as Baba.
So these are the two main different strategies that we use ourselves, and so far it also depends on your own risk appetite. If you are someone who just want to have real income coming in, then dividend stock will be a way to go. But if you want someone to, if you don't mind taking more risk, you want to have more return, then of course you have to go for those type of value growth stocks, where if we rely or we bank on more on like capital gain.
So it's different strategies. It's not either or as well. You can have an exposure to both, but according to what proportion you're comfortable with. Some people just prefer dividends, and some people prefer a bit more capital gains because they feel like there's more upside there, but then you take on a bit more risk.
Some may have both of mix of both.
A mix of both. So it's really up to you. Again, how you want to do it is up to you, your risk exposure and what you like. And we want to share these two examples with you because some of you were asking, how do you actually value companies that were affected by the China pullback and all that stuff. So one is basically Alibaba, the other one is Cheung Infrastructure. I hope that was really, really helpful. And they teach you something about how you can value these kind of companies. All right. So is there anything else you want to share about these two companies?
I think you learn more, especially when it comes to Dividend Machine. We'll teach you how to value REITs and many more methods that we actually use personally ourselves.
And we will talk more in the course also. We're going to talk about Singapore banks also. And Malaysia banks, which we just added in.
Introduced in.
All right.
So we're going to talk about the valuation of the Singapore banks and Malaysia banks.
Banks are pretty, Singapore banks especially, I mean, the dividends are actually pretty consistent as well. Yeah, pretty
Yep.
good as well. So I think we've talked about Singapore banks quite a bit on this roundtable.
Yep.
So with that, I think that's pretty much it, right, guys?
Yep.
Yeah.
All right. So my name is Adam. That is Rusmin.
Thank you.
Victor.
Thank you.
Thank you so much for joining us. Any questions about any of these companies, put them in the comment section. We'll have a discussion with you. If you like this roundtable, please hit the like button and tell us we're doing a great job. Of course, check out Dividend Machines at dividendmachines.com, link in the description, and subscribe to our channel. Many more roundtables coming up, and we'll see you again.